I love this article. This was published in the Wall Street Journal a couple days ago, and it illustrates the exact reason as to why I no longer work for banks. And it's because financial advisors are outsourcing their investment decisions. I shouldn't even say their decisions because it's not their decisions. They're outsourcing their investment recommendations to you. If you go to a JP Morgan, a Morgan Stanley, Fisher Investments, the guy that's sitting at the desk in front of you, he's not the one making the investment decisions on your portfolio. He has handed that off to a third-party money manager that you're probably never going to talk to, you're never going to meet, doesn't know who you are, and your money gets pulled in with 100,000 other people who are seeking to underperform. These portfolios are the bane of my existence, and the problem is they're growing in popularity. The article details how, hey, model portfolio assets were 6.44 trillion last year. Now they're up to $8 trillion as of April this year. That's $1.5 trillion growth in 1 year. These things, look at this, 13.2 trillion by the end of 2029. In 4 years, these portfolios are going to double in size. And it's not because of performance. It's because financial advisors are trained by banks to just sell and recommend these without thinking outside the box, without putting returns and smart money management first. And let's talk about what these portfolios actually are. You can read this article. I'll attach it in the video or in the link at the bottom. But it's an over-diversified mix of stocks, bonds, cash. Sometimes there's gold in them. And it says match with an individual's goals and risk tolerance. That's complete bullshit. They may have given you some questionnaire, but that's just to put you in a box with a bunch of other people that go into this box that they can sell this model portfolio to. Because all these model portfolios is a collection of different investments that this bank already has. And here, I'll prove it to you. This is Fidelity's webpage, and this is a page where they talk about their diversified portfolios. Look at this. They've got, 8 different ones here going from most aggressive to conservative. But all these are a collection and a package of different Fidelity mutual funds that Fidelity has already created. It's fantastic to me. And these are so ridiculous because you look at this. You got 42% in domestic stock, 18% in foreign stock, 35% in bonds. This is a growth and income portfolio. Let's check out the aggressive growth. 25% in foreign stock, 15% in bonds. But I got to tell you, international stocks just don't perform. It doesn't matter what market it is. It could be Europe, it could be Asia, it could be emerging markets, it could be South America. They do not have the long-term track history of performing in any stretch of the imagination. At best, on a long-term performance, you're going to get 5%. Now, sure, there's some companies that are going to do better, and there's some countries that are going to do better. The problem is that you're not betting specifically in those countries. You might have 1 or 2% of your money in Greece that's up 43%, but that's 1 or 2% of your overall portfolio. Also, that's 1 or 2% of 25% of your portfolio. It's such a minimal impact that you might as well not even have it. And I know a lot of people are going to say, well, hey, the US isn't always the best performer. You're absolutely right. I'm not arguing that. What I am saying is that there's no country that consistently outperforms the US, and there's no country that has the consistency of returns that the US does over a long period of time. Unless you are actively trading international stocks, trading meaning you got to buy and you got to do all this stuff, you're probably not going to make a ton of money. If you're just a buy and hold strategist and you just let it fly, you need to stick with the US and you need to minimize your bond exposure. The 20-year average on bonds is 2%, maybe 2.5% because it's come up a little bit the last few years because of interest rates. I avoid bonds at all costs just because something that I know is only going to earn 2%, has a long track history of earning 2%, and carries phenomenal risk in this day and age. When you have inflation that's still, they say it's running 3%, that's bullshit. It's closer to 5%. We all know it is because we can see it in food prices. I saw a video of a guy doing a Walmart reorder. He did an order at Walmart. It was $140 2 years ago. That same order now costs him $414. More than a triple in the cost. And you're telling me I want to put money into bonds that only earn 2%? when these food prices are so out of control? No, it's ridiculous. You need to have US stocks, because why am I going to settle for this portfolio when I can get 10, 12 in the S&P 500? I can get 15 to 17 in the Nasdaq. I can get 20% by buying Visa. I can get 20% buying Apple. Microsoft is already up 12% for the year, and it's only mid-June. And listen, it doesn't matter who has these. This is Fidelity. I can pick on Fidelity. Vanguard has the same stuff. BlackRock, it's the same package, same prize, again, what if you want to call it a prize, in different wrapping. It's just this over-diversified stuff. Again, 20% of your money here, 30% of your money is in bonds that isn't doing anything for you. This is a traditional 60-40 split. If any financial advisor ever recommends a 60-40 split to you, just walk out of their office right away, because the best you're going to get is 6%. And the reason why these are marketed so heavily is because you freak out about the volatility. Okay, so when the market is down 20, these things may be down 12. Depends. But when the market is up 30, you're going to be up 8. You might be up 10, and you just missed 20%. That's huge. On $1 million portfolio, that's $200,000 that you just missed out on that you're not going to get. I was talking to a guy, and he was bragging to me because he's, well, I think he was with Morgan Stanley or something like that. And he's, and I was like, oh, you did 12%. And I was like, yeah. I was like, dude, you got a problem, because the market was up 22, 23% last year. You had $1 million portfolio. I was like, you just lost $100,000 that you're never going to get back. That's more than $8,000 a month extra that you could have had in just 1 year. In just 1 year, you could have had $8,000 more a month. You should be pissed off at your financial advisor. Look at this. You can just buy the triple Q. The triple Q kills the S&P 500. Again, don't tell me you can't beat the market. The triple Q averages 15 to 17% per year. Completely outperformed the S&P 500. The numbers speak for themselves. Look at this. Here's the 5-year. It's up 20% more than the S&P. Here's the 10-year. Look at that. You have 170% more gain on this than you do in the S&P 500. And I know a lot of people are going to say, well, the S&P is diversified and blah, blah, blah. Listen, diversification is a story that's sold to you by mutual fund companies to keep you poor. It only benefits them because they just want to sell you more mutual funds. That's it. You need to stick with what works. And here's what works. Take a look at the trailing returns of Apple. 5 years, 19%. 10-year performance, 20.5%. You need to work on building your own index, because half of the S&P 500 can be cut out. If you're buying VOO or IVV, I get it, but just buy the triple Q instead. It's a much better index. The Nasdaq is a much better index for performance. Look at these top 10 holdings. Microsoft, Nvidia, Apple, Amazon, Broadcom, Meta. All of these are winners, huge winners. All of these stocks have long-term averages of 20% or more. Look at Costco. Look at Costco's beautiful long-term averages. The 5-year average is 28%. Just by sitting on Costco. The 10-year is 22.5. Don't sell it when we're up 100%. It's going higher. It's just one of those steady Eddie stocks that just continues to perform. It's not going anywhere. And speaking of which, none of these companies are going anywhere. This is diversified. You've got tech. You've got retail in consumer discretionary. You've got communication services with Meta and Netflix. Again, retail with Tesla, a little bit of an energy play there. You've got search. This is the top 10 holdings, so 50% of the holdings. Here's the rest of them. AMD, Intuit, Cisco, T-Mobile, Planeteer, huge winner the last couple years. Healthcare, medical, Intuitive Surgical, Pepsi, not the greatest stock, but whatever. Don't tell me the triple Q isn't diversified, because it really is. And you get such a better performance out of this. If you start using the triple Q and then start adding in individual stocks that have these long-term averages, Costco of 22 and 28%, or check out I don't think Visa's in there. Look at what works with Visa. My God. Visa and MasterCard. I'm always a big fan of these. If you don't like banks, just buy Visa and MasterCard. Look at this. Almost 15% on the 5-year. The 10-year is knocking on the door of 19% for just holding Visa stock. Okay, I want to come back to this article because I made my point on model portfolios and why they're not great. But there is a thing in this article that's been mentioned that is going to just unleash a wave of demand. And that's this piece right here. Some are now incorporating cryptocurrencies and private assets. That's incredibly important. Look at this. The BlackRock's iShare Innovation in Tech had a modest 1.44 million in assets under management on May 20th. Now it's at 1.5 billion. The firm drew attention by adding a small allocation to its Bitcoin fund. Again, BlackRock opened up its Bitcoin fund, IBIT. Following the same model, they now have that they can just sell you. And so now they're putting this product into all of their model portfolios, or not all of them, but they're putting them into some of them, especially the aggressive growth ones. Every bank in the world is going to do this. And that is why that is going to unleash, at least by bare minimum, a decade-long demand into cryptocurrencies. Because you have banks that manage trillions and trillions of assets. They're going to be selling some of those assets in those model portfolios and buying Bitcoin, Ether, Solana, XRP, stablecoin, whatever. This is going to just unleash just a huge tidal wave of demand into cryptocurrencies for the next 10 years. You need to be in crypto. You need to be ahead of the game. That's really what's going to make you money. I've been telling my clients easily since 2019 or 2020, listen, this is coming. Banks are going to start doing this. It's just inevitable. I know them because now that they have another product to sell, this is what they're going to do. And this is proof right here that this is now happening.